madness. अब इंडिया करेगा trading. Free data win tablet, free internet and unlimited trading for ₹6666. F6 online.
Did you know an average golf course boasts 100 to 200 acres of green plant cover, creating large urban green belts within cities around the world? The 5th edition of the Louis Philippe Cup is here with an 8-city team pro golf league featuring the top 24 pro golfers in India. 4 days of action-packed on the greens. All fairways will lead to KGA Bengaluru to watch the stars in action. The Louis Philippe Cup 2016 is the greatest show in Indian golf with a total purse of 1.2 crores.
Global markets slide sharply after a shocker of a U.S. report on the jobs market. American companies add a mere 38,000 jobs last month, way below estimates, weakening the case for a June rate hike by the Federal Reserve. And its second straight weekly gains on the Lal Street. Nifty is firmly perched above 8,200 at a fresh 7-month high. As the government considers capping fares for short-haul flights, airlines are up in arms, say any such rule is against free market principles and will make operations unviable. Online taxi aggregators fume at the proposal to ban surging prices. Uber India head Amit Jain hopes governments will come out with progressive regulations. In exclusive chat with ET Now, Jain also says Uber is ready to step up its game in India a day after the global parent raised a whopping $3.5 billion in fresh funds. And Prime Minister Narendra Modi is all set for a 5-nation visit. He is expected to take up the black money issue in Switzerland and the all-important pitch for India's membership in the Nuclear Suppliers Group, as well as easing curbs on US visas, will dominate talks in his second visit to Washington in less than 3 months. Hello there. Good evening to all our viewers. You're watching Smart Markets right here on ET Now in the Mumbai News Centre. I'm Tanveer Gill, and let's go straight across. Joining me on the show to get you a 360-degree perspective on all the market news and the national news are my colleagues Ajay Sharma as well as Krishna Kumar. But let's straight go across and address the top story first, which is really about the U.S. jobs market. That's come in much weaker than expectations for the month of May, which essentially means that expectations of a rate hike in the upcoming June policy meet by the Federal Reserve may get revised lower. To break it down, the U.S. jobs market added about 38 jobs for the month of May, and this has been the lowest addition that we've seen in over a year. Not just that, the unemployment rate also came in at a lesser number, lesser than 5% at 4.7%, which is well in the comfort zone of the Federal Reserve. However, that squeeze in the number has largely been coming in on the fact that the labour participation rate, that's the total workforce which is participating in active working in the active working jobs market, has actually dipped to a 38-year low. So a lot of internals are not looking too good. In addition to that, you had the ISM manufacturing number also, which slid to 52.9 versus 55 on a month-on-month basis. But Ajay joins me, and add into that perspective, Ajay, because this was the last important macro data reading ahead of the Fed meet, and it's been disappointing, disastrous actually.
Well, that's correct. Optically, it looks extremely weak. Just 25% of the expected number has come in this time round. But also take into account that this also got some of the one-offs like the big strike or layoffs that were rising. But of course, even if you add back, a lot of strategists are saying that the number is surely a weakish reading. In fact, if you look at the reaction of that reading immediately, there was a very sharp cut seen in European indices. They went almost 1.5%, 2% cuts were seen. Even the US market trading lower. In fact, this is for the 5th straight day that we are looking at sluggishness as far as global markets go. So let's analyze all of that with our guests on the show joining us. Gurraj Sangha, multi-asset strategist from New York, and Mike Ingram of BGC Partners. Gurraj, thanks a lot for your time. How did you analyze the market reaction of the jobs data, the reading today which was released?
Sure. It was somewhat surprising that the employment jobs created number came in at about 38,000, well below expectations and even well below what some of the whisper numbers were. And I think the main takeaway is that it's pushed back expectations for the next rate hike by the Fed. Initially, the market was still somewhat leaning toward a possible move this month, but that's clearly been taken away, and it right now the market is expecting about a 62% or so chance hike in December, and as a result, although for the near term there's still a lax or less tight monetary policy, I think the equity market is starting to shift the way it traded this year versus last year. Last year, pushbacks in terms of the rate hike cycles tended to be rewarded with immediate equity gains. This year, I think the market is starting to digest the possibility that the underlying economic weakness is much stronger than some of the economic metrics coming out are showing. And although the Fed may not raise rates for quite some time, the underlying economic weakness may translate into weakening profit growth, and therefore valuations on equities would certainly be on the high end, and equities would need to correct.
In fact, Mike Ingram, market analyst at BGC Partners, also joins into the discussion. And Mike, all bets are off for a June rate hike post this jobs reading?
Yes, very probably. I mean, even factoring in the Verizon workers' strike, which probably dragged that number down by 34,000. This is a shockingly low number. The headline number is the weakest since September 2010. Markets up to this point factoring pretty much a 30% probability of a June rate hike, perhaps a 50% probability of a hike in July. I see that receding quite significantly, and I guess we've already seen the reaction in the dollar. Be very interesting to see how Janet Yellen reacts to this latest data point. Of course, it was only a week ago that she dropped her H-bomb hinting at a rate hike in Harvard, but she's in Philadelphia on Monday delivering a speech. Let's see if she tempers down expectations, because that will be just 9 days ahead of the next FOMC.
And Gurraj, that becomes a key imponderable right now, how the Fed really looks at this data. Because if you look at the growth numbers, they've picked up in what has traditionally been seen as a weak winter quarter. The numbers have been revised higher. And, you have seen how consumption is coming back in bits and starts. But if you just look at the core manufacturing activity, it's not been that impressive. I think the last reading came in at 52.9. Add to that there's not been enough increase in wage inflation, plus a poor jobs reading for 3 successive months. Do you think that the Fed would be divided again?
Yes, I think, at least from the literature that Janet Yellen's written about in terms of her view on monetary policy, the wage numbers are actually at a level which historically would trigger continued tightening on part of the Fed, the yearly wage growth, which is in excess of 2%. But that's if the Fed was simply beholden to domestic conditions. And what's happened, at least over the past several years and more recently in the last 12 months, given the developments in China and Europe, the Fed is increasingly trying to balance domestic interests with international interests. And, part of the Fed voting committee is focused exclusively on domestic interests, which would, by and large, suggest continued tightening, if nothing else, to normalize rates and therefore give Fed room to cut rates if they needed to in the future. But there are members of the Open Market Committee which are also are trying to reflect the potential for a continued Fed tightening cycle impacting emerging markets, and particularly China, and also to a degree the European markets, and the secondary effects that would create back in the U.S. So the Fed's in a difficult position. I think they've been trying to walk a tightrope balancing these two interests in light of their dual mandate at home. But the way the market's pricing things in, it's certainly pushed back the potential for a rate hike, to later in the year. And I think that type of back and forth is likely likely to continue given the economic stats coming out of the U.S. They're still relatively mixed. There are strong points and weak points, and
right. In fact, reaction is also being seen on the dollar index, which almost was knocking at 96 till day before yesterday, is back at 94. The CBOE VIX also has shot up almost 7%. Mike, all eyes are now on Janet Yellen commentary on Monday. What would you be watching out for? Do you think time now for her to reset expectations after digesting this data?
Well, she was actually quite vague last Friday, so I certainly can't expect her to be more prescriptive as to when rate hikes might be appropriate. Last week she said it might be appropriate in the months ahead, and she's probably going to repeat that line. Of course, I think this number is so bad, I think she's going to have to specifically address it, and it's going to be interesting to see how she contextualizes this number. Of course, she and the rest of the FMC look at a broad dashboard of economic indicators, many of them unemployment, and Janet Yellen is herself very much an employment specialist. So I'd be very interested to see her detailed analysis. I think the market will be looking for a detailed analysis, not only because of her credentials on the employment market, but of course as the president of the Federal Reserve.
Right, Gurraj, what are your thoughts now, since you're a multi-asset strategist? What are your thoughts on precious metals? How do you think gold could behave? What's the outlook on equities, especially in the mother market, US, because that is a big rub-off on emerging markets? And what about commodities?
Right. Interestingly enough, the precious metals market and by and large the equity markets have traded almost inversely for a greater portion of this year, and I think that tends to occur when there's shifts with respect to view on monetary policy. So, as I generally expect the Fed to, I think this is really it for the year. I don't think they're going to do any additional rate moves. I think their real last opportunity was July. I think after that we get into the U.S. election cycle, and historically the Fed tends to avoid making any material moves in that cycle, so as not to be viewed as favoring one side or another. And Janet Yellen will probably temper expectations in her upcoming speech. So I think that's it for the year. And as such, that historically would tend to lead to putting pressure on the dollar, and which would be supportive of commodities in general. I think the twist this year is part of the movement of for what's happening in the U.S. with respect to economic stats is certainly driven by what's happening abroad. Essentially, credit deflation being exported from emerging markets back to the U.S. And I think that process is likely to continue. So although it means Fed monetary policy is probably on hold, commodities, I think we'll see, some commodities generally trade sideways, mostly the base metals, copper, tin, lead, things like that, in which there's movements upward based on a weakening U.S. dollar and movements downward based upon just weakening, or lackluster demand. Gold, I think, is a bit different. It's starting to emerge more as a monetary asset as opposed to a commodity, essentially a store of value in a currency in and of itself. And for that reason, I think investors would be well positioned to continue to add and accumulate positions on any weakness. And I think gold will continue to be strong for the better part of this year into next year.
Seeming like gold is turning out to be the halo trade for 2016, but Gurraj, being a multi-asset strategist, looking at all the investment assets across the world, across different categories, and sitting out of New York, do you believe that the story in the developed world looks far more engaging, or the U.S. story looks far more engaging, or are you more tilted towards emerging markets, especially India, where the growth numbers look good?
The emerging markets are generally holding up well in light of what's happened, at least with respect to China and what's developing in Japan. I don't think this is the year for a major move in the emerging markets, to the upside. I think this year is more likely the emerging markets will take their cue from the U.S. market, and I don't think the U.S. market is ready. The U.S. market, I think, is in a phase in which it needs to consolidate its gains over the past several years, in light of a shift in monetary policy and probably weakening U.S. situation, given the low yields. For example, the pension fund